The only thing radical would be to decide to ignore science. That would be a radical thing to do.
Our job is to translate beliefs into action.
It would be a negligent board if we didn't include this as one of the things we at least turn our mind to.
This is not at trying to having the members lose money, this is trying to protect their money in their future.
But also on the matter of investment performance, bad performance is intolerable. So for me, the driver of this is performance.
All the focus in this discussion though has been on risk. We're talking about future strategic investments. I think we should be talking about opportunity.
Welcome everyone. As Emma said, the idea of this session is really to look at some of the issues around pension funds investing and taking climate risks into account. There's been an increasing focus on the need for investors and trustees to consider climate change risks in their decision-making process, and it's also reinforced a re-examination of some of the legal obligations of trustees and the measures that they should adopt in responding to these, particularly in the UK, in Australia and the US. As the previous session you just saw on the screen, that was done about 2 years ago, and really the brainchild of Richard Fuller. And what we're trying to do today is really look 2 years further on. What are some of the issues that have arisen since, and what are some of the changes through doing another sort of simulated board session? So in this respect, what I'd like to do is welcome the panellists for today. First of all, we have Frank Pegan, who's the CEO of Catholic Super and will chair the board today. Also, Kath Botwell is a Director of Industry Fund Services. Jeff Flake, a Director of Vision Super. Professor Kate Auty, who's the Chair of University of Melbourne's Advisory Board for MSSI. Helga Brigden, who's a partner with Mercer and will act as our Chief Investment Officer today. And myself who will give some guidance on some of the legal issues. So before we start, I'd just like to hand over to Helga, who's just going to say a few other words.
Thanks, Martijn. Don't know if you can hear me. I just wanted to dedicate this session to Dr. Richard Fuller, who was really the person that developed this idea and did a lot of the work for it. So this is in Richard's memory. Thank you.
Okay, I'll start again very quickly. Welcome to the Directors and Executive Perfect Storm Pension. Background, it's a $30 billion fund, over 200,000 members and 7,000 employers. I've called this urgent meeting because the fund has been issued with a summons from a number of members in regards to the investment they undertook 2 years ago in the North Coast Port and the coal terminals. The summons basically states that we failed to consider the risks, we paid too much for the asset, and we're exposed to massive losses due to the change in the carbon use. And before I ask the board to consider this, there are two things I need to make clear, is that at the time, Kath and Jeff were at the meeting, Frank and Kate, that's myself and Kate, were not at the meeting. So before I ask Martijn, not relevant, but before I ask Martijn as the expert legal advisor, is there any questions from the board about the summons? Well, since there's no questions from the board, I'll ask Martijn to two questions. What is it that we as trustees have an obligation to do in regards to the summons? And what do the fund trustees need to show to have acted properly?
Thanks, Frank. Well, in one sense, it's a pleasure to be here, but in another sense, it's not. I think, as we've discussed previously, in the past, the idea was that a fund taking the sole purpose test under the superannuation legislation really should be looking at managing its fund to get the best financial benefits for its members, looking very closely at that. But increasingly, trustees are also legally required to have regard to the risks of their investment and to exercise a degree of care, skill and diligence when they're making decisions and looking at all the factors that could affect that. That also is important in taking into account very specific risk management procedures and the way in which you go about making those decisions. And I think, as we'll hear from Helga, at your previous board meeting, you adopted a number of resolutions about the process that you go through to make decisions. So it will be interesting to understand today what some of those processes are. But if you're going to categorise the duties that you have as trustees, one is a duty of skill, care and diligence in looking at investments. Secondly, is a duty to prudently manage your investment risks. Thirdly, and this is a particularly important and challenging issue, is the duty to consider the long-term perspective of investments. And finally, a duty to diversify your risk across your portfolio. Now, all of this is very context-specific, and so in that sense, we need to very carefully look at the investment you made, and on the screen behind us are some of the facts that apply to the investment that you made here and things that were or were not perhaps in this factual situation which we're presented with. The other thing I think which will be interesting to hear today is what were the sort of things you took into account 2 years ago and what was very relevant then, and the extent to which things may have changed over the last 2 years that give you a little bit of a defence or a little bit explain the reasons why you made decisions at that time which you may make different decisions today.
Thank you, Martijn. Before we move on to Helga, our CIO, to talk about the reasoning and the process, I just will list out a few of the notes that the board agreed at the time. The investment committee had all the relevant information before it when he made the decision. This included historical data underpinning forecasts. The historical data would have justified a bid for low mid price of valuation of 1.2 billion, but it was the forecast uplift in demand that underpinned the projection of 2 billion. The due diligence included an engineer's report on structural issues facing the seawall, which was reported that the wall had to be date-proven effective. The storm damage to the wall occurred after the fund had acquired the port. There was a section on climate risk in the due diligence report on the port, which focused predominantly on the emission intensity of the port itself and not on the externalities. The investment committee's recommendation to invest was unanimous, but the board itself approved the bid for the price. So now I'll pass it on to Helga, our CIO at the time, to go through how the process was undertaken to invest.
Thank you, Mr. Chair. And just a refresher to the board on why we invested and how the board took the decision to do so. We did actually have an explicit climate change policy, and we took climate change to be a systemic risk, and we felt that we had implemented this policy. We'd also incorporated climate change in our investment beliefs, and so when we were taking a look at this investment, we acknowledged that climate risk was going to play into it, but we didn't look in any detail at that time, remembering that things have changed quite dramatically in the last 2 years about our climate risk appetite. Our second resolution and policy principle against which we took the decision was that we should receive an annual update from the board should receive an annual update from the investment committee on how the investment implications are going to play out in our investments. So we got some annual reports, and we do get independent valuation reports quarterly to the investment committee. So we got some comfort because we did survey our managers at that time, and about 40% of them said that they had incorporated climate risk into their investment process, and say that it is part of their consideration. And a similar amount of managers reported to us that they have some targets around carbon intensity. So I remember at the time that, we took some comfort from that. We'd also done some benchmarking on our domestic and international listed equities and looked at how we measured up against peers, and we had some reporting on that. We were found to be slightly underweight carbon compared to our peers, And we also took a look at our property portfolio, and we were ranked just below median on a sustainability index at that time. And we, as the investment committee, did note to the board that we were looking to develop a suitable benchmark for infrastructure assets. Our third principle was about the strategic implications of climate change risks, and we did agree, and the board did agree, that they would be formally part of strategic reviews, but we didn't go into a detailed analysis of this at that time. We also recognised that we could do some asset class reviews to look at climate risk and what the opportunities might be. But at that time we had not yet identified specific actions or targets. We also looked at the question of timeframes and what the implications would be in our meeting 2 years ago, and we did agree it was a long-term issue and that we would be anticipating any long-term outcomes. We had noted that there should be considerations of a 2-degree scenario, and that there'd be regulatory changes which would be considered in this long-term view. And the final 2 resolutions that the board took, which framed our decision at that time, was around allocation, and we did note that we wanted to seek low carbon investments on an appropriate risk for return basis. And then finally we did ask the investment committee, or the board did, to adopt a methodology for measuring the fund's exposure to climate risk. So they were the key principles. And finally, we also undertook to communicate about our position on climate change and make our members aware of the fund's approach, and make that public in terms of stakeholders. So they were the key principles which were accepted and guided the decision at that time. Thank you, Mr. Chairman.
Thank you, Helga. And now I'll open it for questions from the directors.
Not having been on the board at the time, Mr. Chair, through you, if you wouldn't mind, I'm really a bit perplexed as a lawyer myself that we're having this urgent meeting in response to a summons, and I'm wondering why or how we've got to this stage, having the annual report backs that we've targeted for ourselves under the resolutions. But I'm actually very interested in why we don't have a climate risk register.
Well, of course, it's not for the board to develop the climate risk register, it's for the management to bring that to us for our approval. But I think that one of the things when I think about this investment, and I'm not sure if the information, they're the resolutions, but the information that was on the screen before indicated that, you know, we'd paid at the upper end of what would be a fair value for this asset. We clearly outbid the next closest bidder. But on the cash flow and, you know, it looks like we paid about 12 times earnings or something. If you think about the infrastructure market at the time, some people paying 20 times, you know, we've got a weight of money that we've got to get away in infrastructure assets. So I think we've got to go back and think about, you know, what our thinking was at the time when we approved the bid price. And I think we've got to think about whether we followed the investment governance arrangements that we had in place at that time, which included properly setting a risk appetite. But a risk appetite is a fund-specific thing or an asset class-specific thing. This is actually about this particular one asset. And as a board member, you know, I wonder where my responsibility stops in terms of making sure we've got a good governance process in place, and where I'm responsible, and I wonder if our lawyers could help us to actually drill right down into the assumptions underpinning the valuation on a particular asset. It's a big asset in our fund, it's an important asset, and it did come to the board, but I'm interested in what my responsibilities might be.
I think, as you've seen in the fact scenario, I mean, it's an incredibly complex a range of issues here, and I think the core of the valuation goes to looking at both the input through the port, so what actually comes through that port, how do you actually make your revenue? So it's not good enough to simply say, look at the accounts of the port and say, well, it made this amount of money last year. It's important to say, how did it make its money? Is the sources of that income likely to change? Are those stable sources of income? Are there things that we could see over the long term that may change the impacts of that income stream? And so it's looking at the broad range of different factors. Also, I think on the fact scenarios, what's the future use of the port? There's an interesting caveat that in the sale of the port, the government was very keen that it retains itself as an infrastructure asset and as a port servicing that community. So I think one of the conditions of the purchase was that it can't be rezoned. So any sort of quick decision to try to rezone some of the port as residential apartments, for example, to make a quick buck, also wasn't going to work. So I think, what are both the sources of income and the way they can be affected in the future, but also the constraints of that income stream, and also what are the opportunities to increase the income stream, all need to be considered.
And Jeff, any comment?
Well, I guess as one of the two directors who is still sitting around this table who was part of this decision last time, I can just recall how much Kath was championing this investment. I mean, this came out from one of those industry fund collective vehicles, and this was one of the assets that they didn't want to put in the collective vehicle, but it was an offer too good to be true, and they brought it to us. And Kath convinced us at the time, along with Helga, that the cash flows that this port offered for us was so compelling that it deserved to be our first significant standalone investment. And a big one for us, a $30 billion fund investing $2 billion in one particular asset, was really significant for us at the time. And I do remember we did give it particular consideration. This wasn't an easy decision for us at the time. And for me, I supported it and I developed comfort around it when I looked at the cash flow forecasts. I looked at the pipeline of work that seemed to or the investment that was likely to be happening in these coal mines. I can't remember how we applied one of those investment principles that Helga outlined earlier around seeking to reduce our carbon footprint, and somehow decided to spend $2 billion on a port that basically only services coal mines. But nonetheless, our focus was on cash flows which were healthy. There's obviously been some things that have changed since then, but we can't be responsible for things that have changed. That our diligence at the time had looked on the horizon and I think had appropriately looked at and appropriately assessed these risks. Unfortunately, we've just been caught out. This has been a bad call. It's just unfortunate it's such a big call.
I'd just like to respond to that, Jeff. I think there's not a lot to be said for division amongst the board at this time, and while Kath might have been promoting it assiduously at the time, I think we need to resolve the situation now. We're facing this summons. It's really deeply concerning. It's concerning for our reputation, amongst other things. It's concerning for our members. The real question for me comes down to how vigilant we've been over the 2 years since we've actually purchased this asset or found ourselves in this situation. And the price of coal's been falling through the floor, and it's fairly clear that we probably have to be more vigilant in the future. But I'm just a bit perplexed about what's gone wrong. And we've got a number of resolutions and protocols, but it seems that we probably haven't met them. And if we haven't met them, why haven't we met them? And how do we fix that situation so that we can assure our shareholders and everybody else that we are not ourselves redundant like coal?
Helga, could you give a response to that as the CIO?
As your humble servant, I think this is of a concern, and I suppose what we see here is there is a gap between the principles we adopted, the policy, and the actual implementation. As I recall, however, we did have a special engineers report commissioned. We did take into account the valuation, and yes, as my colleague to the right has pointed out, it looked like a very attractive proposition at the time. It seemed to have a good earnings cash flow. So we do acknowledge that executive management should have done more work, particularly in closing the gap between the principles, the policy and the actual implementation around risk, and also not just the reliance on backward historic investment return data, but undertaking more in-depth analysis on forward-looking projections, the way in which there have been structural changes in the energy mix and the role of ports, increasing environmental legislation and so on. So we do recognise that there's more work to be done that the policy really needs to drive.
Frank, I just wanted to ask a question to Martijn. If I recall correctly, I think most of our focus was on the business case for this investment, and we did acknowledge we had this climate change policy. I do remember us going through it, but I'm not sure the level of diligence that we applied to it when we did go through it. Our focus was much more on what we saw as the potential return objective. So as far as our liability now with this lawsuit, I mean, to what extent can we be held to account for this climate change policy that we embraced more because of the goodwill we wanted to generate with our members? We saw it as a marketing opportunity as much as anything else. Is this now going to cause us grief with others holding us to account for not actually having followed it more prescriptively?
I understand from Helga that it was a little bit more than a marketing policy. I understand that you did have a board meeting specifically to consider this, and I think it's probably a little unfair to put on your fellow board members that it was really just a PR exercise. But having said that, yeah, I mean, you're held to account to the risks that existed at the time of you making the investment and what was considered to be appropriate, and what investigation you did. So the question I really have for you is, there was a reason that you made this policy at that time. There was a reason that you responded to develop the resolutions that are on the board. So what was your thinking? Why did you decide that climate change was sufficient to come up with these resolutions? You must have considered it to have been some sort of risk, and then we can test to what extent you evaluated that risk with proper care. A lot of the issues which we're talking about today have progressed significantly since that time, but there are some interesting things here. I mean, when you got your report on the seawall, for example, you worked out whether that seawall was structurally sound. You didn't give instructions to work out whether the seawall could withstand the sort of predictions that CSIRO had on the table that were likely to impact the port in the next 3 to 5 years. So I'm sort of curious as to, looking back, you may have done something different on that. But again, what was the driver behind you adopting these resolutions at the time? What was driving that change in thinking?
Well, as the person who was at the board table at the time and was also primarily responsible for this particular decision, I think we were thinking at that time that this was a whole of portfolio issue, that we, certainly in my view, and I know this is a big asset in our portfolio, it wasn't going to be for the trustee to look at every single asset and only invest in low emissions intensive assets or only invest in green assets, that we wanted to take a whole of portfolio view. And I think if you look at what we've done as a fund, we've benchmarked our international and domestic listed portfolios, and they are slightly below our peers in terms of emissions intensity. So we've got a greener portfolio than our peers. We're a little bit over in terms of our property portfolio. That's a small part of the portfolio. So we have been moving over the medium term to reorient the portfolio to be one that is consistent with the policies that we passed. And I think that we clearly haven't done as much as we could have done, but I don't think that we've just passed a PR policy and then sat back, put it on in a glossy brochure and done nothing about it. And I guess in thinking about both the general risks to the fund and the express litigation risk, I have a question about that issue too, because each asset, you're going to make mistakes in investing. You're going to get your valuations wrong in investing. You're going to overshoot sometimes and undershoot sometimes. if we're going to be held accountable for every single asset that we're invested in, I think that makes our job really, really difficult. And I'd be interested to understand the extent to which it's an asset-specific or decision-specific thing, or whether it's really about our processes and governance.
And I support what you said, Kath, that we look at it at a whole portfolio level, not asset by asset. When we put together a portfolio, it is made up of a number of assets. A single portfolio might have a low risk and might be what you call not carbon intensive, but an individual asset might have a higher risk and a higher carbon outcome compared to other assets in that portfolio.
So just to add to that, I mean, if you think about an asset like this, it's such a big asset that a material devaluation of the asset is going to make our performance very lumpy, and there are inter-member equity issues around that if the members who paid too much for it, other members buy in at different prices and so forth. So I'm not discounting the asset by asset thing, but I do think that as trustees, we are not the people generally making any of the asset decisions. Most of them are made by our managers, consistent with a broad mandate that we give them.
So what's your view, Martijn?
I think it's very easy. The bottom line is that the law places the obligation on you as trustees. It doesn't place it on your investment managers. So it's not good enough to say that my investment manager gave me a report and I'm going to rely on that. And simply, I think in the past that was very much the case, but I think nowadays, as these risks become more and more clear, that obligation is on you as trustees to turn your mind to that. So how do you do that? Well, you have to develop proper policies and strategies, as you've done. And part of my mind is it's not so much a question of the policies and resolutions you adopted were wrong. The question is, to what extent have you actually adopted those or paid lip service to those? I think, Helga, it might be useful to have a little bit of guidance from you as to, in your view, have you actually, as a fund, pursued the course of action you set yourself to do?
Well, as noted earlier through you, Mr. Chair, we did adopt the resolutions and policies and applied them to our investment process. But as we noted before, there still is work to do about our understanding of how do we measure such risks, as particularly when there is a significant asset in the portfolio such as this, while noting that from the board's point of view, there is a portfolio-wide responsibility, but also noting that we are obliged to understand the investment process, and that both the investment committee and board do need to understand and be across the way in which we are invested and what it actually means. So I do take from this experience that we're having with this legal issue before us that we now need to quantify in much more detail our risk appetite in relation to such assets, and really do more homework on a number of the principles we've adopted.
I think one comment, to come back to the earlier point, is that is an asset like this, which has such a very large, significant impact on your portfolio valuation, is something you need to look very closely at. But also, one thing we should think about is the summons is about is partly about climate risk, but it's also about devaluation of the asset. So part of this summons is not necessarily directed to climate change; it's actually directed to just a simply bad investment. And so it's a sort of a twofold summons here by an agitated class of investors who basically are very unhappy with what you've done. So I think we need to very carefully think, at the time you made that decision, did you exercise the right amount of care and due diligence in making that decision?
And, so if we just extend that, and if the conclusion is that we have breached our fiduciary duties, which we owe, are we liable personally as directors, or will our directors and officers' liability policy stand behind us and protect us personally, and effectively, perhaps if this lawsuit is successful, compensate members who are angry for how we've turned $2 billion into, well, $500 million if we can convince the government to let us rezone the land?
That very much depends on the terms of your insurance policy, and we'd have to have a careful look at that. But as you know, in some cases like James Hardy, where directors have gone beyond the terms of their insurance policy, they can be personally liable. So we haven't got to the point yet as to whether we think this is a valid summons or whether this is an amber claim. And we'll talk about that in a moment. But it just highlights the point that directors need to be very carefully looking at what their insurance policies are, what the exclusions in those policies are, and what they require of you. And recent cases, have made directors personally liable.
Just a comment in relation to the resolutions, and the last of them is about communication, Resolution 7, and it seems to me that we've been probably quite bereft in relation to that, in that we've done very little or nothing in respect of communicating what we've attempted to do in relation to the other resolutions. That, for me, from the point of view of running litigation, if I was suing us, would say that there should have been some pickup of the warning signals, because we weren't communicating, we had nothing to communicate. And what does that tell us in relation to this litigation as to our risk? Does it elevate it, or does it mean that we just simply washed our hands of it? What does it say to you, Martijn?
Well, it wasn't actually raised in the summons, fortunately, so so it's not such an issue. But I think the fact is, if you commit to these principles, you are committing yourself to your own sort of standard of care that you want to pursue, and it raises the fact that you're aware to the importance of these issues and that you've signalled them out in a board meeting as trustees yourself. So you, as trustees of the board, have committed to this, and so it raises a sort of a level of awareness and diligence that you've actually committed to. So yes, it's arguable that you're held to a higher level to account.
Thank you very much. If any further questions? Well, very quickly, I think it goes back to the heart of what was the process, how was the decision made in investing in this asset to be very important. So therefore, I will ask Martijn what he thinks, what actions are required, what are the defences, what lessons have we learned, and what do we do as a board going forward in setting our strategic direction?
Well, Frank, I think that, as I said at the outset, this is a very complicated case and involving a lot of factors, but it's not too dissimilar to some recent investments that we've seen in Australia in, for example, the Port of Newcastle, that do carry some very similar parallels to this example that we've had on the board. And there are a wide range of issues, both up and down the value chain, that actually go towards the long-term financial return of this asset, as well as the climate impacts on the port. There's no doubt that the fund had a clear strategy in place. That strategy did take into account climate risk as what you thought at the time was relevant. You did have an independent person look at some of the issues around climate. You did look at the revenue flows, and you did make a call on what the value was, and you intentionally decided to up that bid because it was a competitive process. And I think you can probably justify the reason that you paid a higher price. I think in this sense, the judgments were at the time based on available information, and probably on balance, you did exercise skilled care and due diligence. If you're making this decision today, though, I would say that you probably didn't look far enough down to the sort of changes that are going on in the sector, and that will affect the revenue flows through the port. Also, things like impacts on the climate, impacts of climate change on things like the seawall. In instructing future experts, you need to make sure that they themselves follow some of the resolutions and the guidance that you've given. So I think on balance, you could probably say that you did exercise care and diligence at the time, but going forward, it's very important that you actually take things into account, but probably in greater detail. I think the important things to say, in the last 2 years since this investment was made, we've had significant change. It's a rapidly evolving space in the energy sector. The coal sector is changing. Perhaps even last week, overnight, the shift from diesel to electric vehicles as a result of the VW case may be a significant change that you would need to think about if you're investing in that sector in the future. In California, you have the government in California last week requiring 2 of the state's largest pension funds to divest their holdings in thermal coal. So we're seeing legislative changes happening very quickly. And interestingly, it's often said that the jurisdiction that provides the greatest amount of level of duty of care is the UK, followed by Australia, followed by lastly the US, where this duty of care is probably less so in terms of climate risk. Yet at the moment we have 2 significant court cases going on in the US against trustees of pension funds for not taking into account the decline in coal assets, both with Peabody and Archer Coal. So although we hear a lot about these test cases, that there may be litigation, and some of these, these claims coming down the pipeline, they're already actually started. So it's clear that things are changing very, very quickly. So I think some of the lessons that can be learnt are, one, as a fund, you've been very good in adopting these resolutions, but you need to implement them and stick to them. And you need to make sure that you have a way to implement them, and I think, as Helga said, very carefully monitor that implementation. You need the skill set available to make the assessments that you need to make. You have to keep these strategies up to date. You have to also ensure that the investments are made in accordance with the policies that you set out, and those policies can adapt. And that you also need to understand that if you hold assets that are perhaps get into trouble, how you can exit from those assets, what's your plan to manage the risk that comes in the future. So there are a range of different strategies that you can adopt. And I think, while often people might talk about ambit claims, having these sort of policy and procedures in place provides not only a good defence, but it's a great opportunity to assess what are excellent investments in the future to get an even better return for your investors.
Thank you very much, Martijn. Can I ask each of the directors and executives the observation of Martijn's summary?
Look, the thing that I have taken from this discussion is that I think we've had a pretty good set of policies to start with, and although we don't like the circumstances where we're now 2 years on, I think we applied them in a reasonably defensible way 2 years ago, in coming to the conclusion, for business reasons, with good business judgment, to make this investment. I think where we may have been a little bit derelict in our duties in more recent times has been the way that we've actively monitored this investment in particular. There have been warning signs. We've known for at least the last 12 months that a number of the coal mines in the area have been failing or have been getting to the end of their useful lives and don't seem to be renewing their infrastructure investment. And I think that perhaps this is a conversation we should have come to maybe a little bit earlier than today, being 2 years on. So the lesson that I take from this is that not only are these policies that we adopted a few years ago important at the stage of when you invest, but they're important policies that we need to apply more rigorously in the way that we monitor and evaluate our investment portfolio on a day-to-day basis.
Look, I had a fairly similar response. I'm very pleased that our legal advice is that we're likely to have a defence to the litigation. That's obviously a pleasing thing, but it does make you think a little bit about what you would have done differently back 2 years ago when we made this investment. And for me, when I think about how you look at the valuations, there's a lot of finance sector orthodoxy that perhaps we just have to challenge a little bit when we look at that and just bring a bit of a scepticism to some of that orthodoxy. I think that we generally rely on projections that are based on historical data, and we have to probably be a bit more brave about forecasting and looking forward and looking at scenarios that seem a bit wacky at the time. And for people who are relatively conservative, and that's the way we try and behave as investors, inviting people to bring wacky scenarios to the table isn't something that we do with much comfort, but I think we probably have to do that. And then the other thing I really thought about was the way this should have been flowing through, these risks in this asset, even if we didn't see them at the time we invested. We should have been seeing that in the earnings of the asset over the last couple of years and the carrying value of the asset. So looking at valuations constantly and refreshing those would have been a warning sign that perhaps something was amiss.
In the spirit of collegiality, I agree with both of my colleagues on the board. Can I make a couple of observations just additional to those, and I think they're really well-founded observations. One is that when we set ourselves the project of communicating what we wanted to do with our climate change policy to our members, if we'd followed through with that, we would have been constantly engaged in a feedback loop ourselves, because we would have been asking what had we communicated, if we were communicating what we were reading in things like even the Financial Review about the price of coal, for instance, we would have been constantly second-guessing ourselves. And the other thing I would say, coming from my background in relation to multidisciplinary practice, I think it's always very useful to say, well, an engineer might say the seawall's okay, but what does a climate scientist tell us? And I think we need to be far more broadcast in the way we seek the advice of disciplines, and that's what I'd be urging us to do in the future.
Thank you, Kate. I'd say that picking up on those questions, we obviously look at the financial impacts, but also other impacts and the interests of our members and other stakeholders. So what we need to recognise in our investment process, I think in more detail as we've talked about today, is getting a really good understanding of what is our carbon exposure and how we're going to manage for it, and questions such as whether we should be looking at portfolio targets for carbon intensity, strategic targets, and undertaking much more modelling around risks, the impact on returns and the variability of returns, and also looking under the bonnet. And I think for both Investment Committee and ultimately the board, we need to have a stronger analysis of what's happening at a sector level and asset class level, as well as portfolio level. So it really gives us a different frame on governance in relation to these sorts of risks.
Thank you for my colleagues. My summary is policies number 1, process number 2, documentations 3, and 4th is review. But as far as risk to me is about the future of owning an asset and holding it. I think the decision to invest in this infrastructure was more around compliance, which looks at the past. And therefore, going forward, we need to define as part of our review what is risk. As I said, risk measures the future, which has a lot of unknowns, and is exactly what happened here. When we decided to invest in this, we invested in terms, it was compliant. The cash flow added up, compliant with the regulations at the time, compliant with the climate change policies, but it wasn't about risk. So now we have time for about 8 minutes for questions.
Elaine Pry from City Research. A question perhaps for the Chief Investment Officer, but for anybody who'd like to take it, was we've talked, or you were talking a fair amount about portfolio intensities and metrics and so on, but would you have had a metric that would have taken into account anything to do with the fact that your rail and port was actually serving coal rather than say that it was wheat that was going through your system? In other words, what actual arithmetic were you using that would have reflected that, rather than simply the emissions from actually driving the trains and operating the machinery? Maybe
yes.
Is that the most
Thanks,
useful
Elaine.
metric then?
Brilliant question as ever. We did acknowledge that was one of the weaknesses in our valuation, that we really hadn't come to grips with the commodity that was the driver of the economics of this investment fully, and so it was inadequate in terms of understanding and analysing the coal implication as opposed to some other type of commodity in the investment process. So that definitely was a weakness in the judgment. Did you have any comment, Martijn, or anyone else?
I think we had in our agreed facts, I'm not sure if they came through, that we did get an emissions intensity report on the port itself. And it wasn't too bad because it was a pretty efficient port. So terrific. Tick that box. So I think that is an issue. But I think it was also in the paperwork, maybe didn't come through, that we had considered alternative commodities that could flow if there was a decline in the export of coal, and that we had thought about the potential for agriculture. Now, of course, there are climate risks with agriculture as well. So, yeah.
Is that working? Yeah. Bill Hartnett, Local Government Super. I'm just wondering about the skill sets on the board for evaluating climate change risk. There's been a couple of changes beforehand, a couple of long-term directors where this mistake or unfortunate investment has occurred. There's been a couple of changes over. How do you go about selecting your board, and going forward, do you think you would look at more strong climate change skills on the board?
Well, I'm so pleased you've asked that question, Bill, because as you'll see, we have attracted a climate expert to our board in Professor Kate Auty, former Commissioner for the Environment and Sustainability, and this is exactly the role modelling we like to see on our superannuation and other boards, and so we're showing you how it can be done and the excellent insights that it provides.
And can I defer to the climate experts I do know, like Professor David Caroli and David Griggs, and of course those skills are readily available to any board. They are, of course, people in universities, and we should be taking advantage of their willingness to be part of these extraordinarily tempestuous times, these discussions that we have to have.
Another question?
I was just going to comment also, if you have a very good strategy, such as the one behind, then as a board, you should become aware of climate risk. You should know it exists. So then, as Kate says, you can go out and get the expertise that you require. So, there are many, many issues that boards have to consider, and you can't have a representative from every particular context and every particular risk. But making sure the board is aware how to assess those risks and gauge what they are is the critical issue. And then being able to draw on the resources they need to address them is what's fundamental.
Another question?
Rob Fowler from Hester. A question to the board, but I suspect Helga ends up going to you anyway. Let me put a hypothetical case to you. Two eminent broking analysts, one ex, one current, have put out a research report on Peabody Coal, who was mentioned a little bit earlier. So Elaine and Tim Buckley have both put out separate papers where they're convinced that the debt problems that Peabody has can be overcome. In fact, the financing's been put in place to let them keep going. Each of them are forecasting over the next 10 years an IRR of over 40% on Peabody Coal, because it's been hammered so much by the markets and arguably people selling because it actually produces thermal coal. Do you think your board or do you think your fund should be allowed to buy that asset, given it's still thermal coal? But these eminent forecasters and brokers are actually suggesting it's probably one of the best returning assets you can buy for your portfolio over the next decade.
Well, I mean, in my view, and we've had some of these debates around the other board table that I sit on when I'm not on this one, and I think that's the whole crux of the debate around what role climate change should play in investment policies, and I think it's up to funds in consultation with their members to determine that answer. And if the answer is that climate change should play a key role, then I think that does then mean that there are some investments, no matter how good performing they are, that should be off the table. But I also think there's quite a defensible approach open to boards as well to decide that climate change should be seen as a risk and an opportunity, and not something that should veto investments in some areas on more sort of philosophical or political grounds. But I know there's funds in this room that have approached that question differently. For me, I prefer the investment decision should be based on investment grounds, and that means that climate change risks should be taken into account, but it shouldn't be climate change vetoes.
So I think it also hits one of the important points here, which is that if the fund looks at Tim and Elaine's reports and says, well, we know these reports are there, we know there's a risk, but when we've assessed all these risks, we still want to invest anyway, and our members agree, then they've exercised their care to make that investment. Everyone's fully aware of what they're doing. So there's a difference between what is making an investment and what is perhaps a legal obligation. But if I was giving the board advice, I'd say, well, Peabody there's litigation at the moment against a pension fund in the US for investing in Peabody. If you read the statement of claim and the extent to which the investors have significantly breached their duties in US law, why not just wait and see the outcome of that court case? Why don't you see what's going to happen, what it says, what implications that has for you, and it gives you a little bit more time to test whether Tim and Elaine are right or whether the market's right.
We've got time for one more question. Sorry, I've been just chopped at the head. So thank you to all the participants up here, and thank you for the audience for listening.